Welcome everyone to Ask the Experts CARES Act 2020. My name is Bree Sioni and I'm the Vice President of Development and Strategic Partnerships for RMHC Bay Area. Before we get started, I just want to call everyone's attention to the welcome screen. We are going to have live question and answer with our panelists. As you can see down at on the screen, you have a couple of instructions here. Please use the Q&A button if you have a question. You can then call to my attention by raising your hand. And the panelists have requested and agreed to take questions as we go. So you don't have to feel the need to wait until there is a pause in the presentation for your questions. We will also have time at the end of the session to answer your questions as well. But before we get started with our content, I want to turn the time over to our CEO, Laura Keegan-Boudreau. Laura.
Thank you, Bree. So thank you everybody for joining us. We're really excited about today's webinar. Philanthropy is our fuel, and the new rules around charitable giving can make a world of difference for organizations like ours. Because of donor support, we've spent more than 40 years keeping families with critically ill children together near the care and resources they need. We've been able to grow and evolve as needs change. So when Lucille Packard Children's Hospital grew, we expanded. We grew our facility and our programs. And we now support 123 families every night with a place to stay, with hot meals, psychosocial support, an on-site school, and much more. And when UCSF opened its new campus in Mission Bay, we were able to open a space inside the hospital so that parents could have support and respite literally steps away from their child's bedside. And today we're able to think about bringing support to Oakland Children's Hospital, where families have a tremendous need for food and respite inside the hospital. And because of donor support, we are also able to adapt when things get tough. And they have probably never been tougher than in these last few months. COVID-19 has changed the way we deliver every aspect of our care, from serving meals directly to guest rooms so families can shelter in place, to providing school and psychosocial support remotely. It has also exacerbated the health disparities that already affect so many of our families, amplifying issues of healthcare access, income inequality, the disproportionate burden of illness on racial and ethnic minority groups. But together as a community, we can adapt and innovate and find solutions to all of these issues. And that's the power of philanthropy. So again, thank you for joining us and for thinking about how to make the most of your charitable giving in support of organizations like ours. So we'll turn it over to Mike and Joan.
Thank you, Laura. I want to give a little bit of background about Mike and Joan, who are joining us today from Deloitte. They're doing this in partnership as in a volunteer capacity. So we're really, really excited about having them join us today. Joan McMahon is the Tax Managing Director, and Mike Schleck, the tax partner from the office in San Francisco. But really, I mean, they could be anywhere in the world today. And I'd like to turn the time over to them. Mike and Joan.
Great, thank you, Bree. We're very, very excited to be here with you this afternoon, and just to share a few minutes and some insights on charitable planning in today's environment, and as you mentioned, this much needed fuel for every organization, especially right now. As you all have heard, it was there was an act that was put into place in late March, the CARES Act. And Congress signed it, it was signed into law March 27th, and it was a true $2 trillion economic relief package that was to help with the impact of COVID. And so as part of that, we're just going to talk about one little piece of that today. And one of the provisions that is in there was designed to help both individuals as well as charitable organizations. And it was meant to help get some money back into those that were doing good work. And it's a provision that's related to charitable donations. And it allows you, there's two parts to it that we're going to talk about today. First of all, the CARES Act allows you for this year only, 2020, if you give cash to a public charity, you can actually give away and deduct up to 100% of your adjusted gross income. So for the non-tax people on the phone, that's generally your income minus just certain deductions that you get to take. It's not your things that you might itemize, like your house interest or something, but it's generally you can give away literally and get a deduction for up to 100% of your income this year and pay no income tax, as long as that's a cash donation that's going into a public charity. It does not include money that you might want to give to a private foundation, and except in very limited circumstances, they have to pass it through. And it also does not include donations to donor-advised funds. And the reason, the general reason behind that is those tend to be organizations that while they have some distribution requirements on private foundations, it's also that not an organization that necessarily has to spend that dollar today, as with a public charity that has an ongoing mission that the idea is the money can get out and start doing good things like right away. If you end up donating more than that and you have excess cash contributions, you don't lose the benefit of it. You can carry it forward for 5 years and deduct it in a future year. And if it's cash, it's deductible up to 60% of your adjusted gross income in future years. So that's still a pretty good deduction. But again, for this year, it goes from 60 all the way up to 100. The CARES Act also threw in another provision, because there's a lot for people that don't itemize deductions and those that don't have enough to actually take advantage of, and maybe of the increased in the 100% limitation. And these are people that if you file a tax return and you take the standard deduction for single people, that's like $12,400. That's that deduction that the government gives you on your tax return that you get to offset against your income. And then for married, filing joint, it's like $24,800. It's double. So if you're in that bracket and you don't normally itemize your deductions, like you don't have house interest and your real estate taxes and things like that, you also now can get a charitable deduction. Before you couldn't get one because you would to have the standard deduction. The CARES Act is now allowing you to deduct up to $300 as what we call above the line deduction. That means you can, in addition to your standard deduction that you get for tax purposes, the IRS is going to allow you to do another, on top of that, an additional deduction of $300. Again, cash going to public charities, paid in 2020. Okay, any comment? Yeah. So let's talk about what is.
I would just add, Joan, so we make it a little, that way you don't have to feel like you have to present everything on your own. I would just add that, the one thing, I'll go back to the slide 1 second. On the $300, this is going to affect every taxpayer in the country that arguably wants to do this. It's possible. So what that means, though, is that this is unprecedented. I don't think, Joan, keep me honest here, we have ever seen this special carve off for the $300 before, nor have we seen the 100% limitation. And so what Joan and I do at Deloitte is advise clients, much like yourselves on this webcast, about how to work through not only the tax aspect of this, because it's a pretty straightforward tax answer. It's, you give it to a public charity and you get a tax deduction, and the government will effectively not tax you as much. But it's also around philanthropic and making a difference in the community that matters. And the purpose of this, as Joan was alluding to and said, was to make a very direct direction to the country to say, we are going to create an incentive for you to give to charity, to allow the government not to be as burdened, because people, like the Ronald McDonald House, are doing things that benefit society in and of itself, and is helping through this virus situation and the challenges that we're facing. So I just, if you haven't planned on giving at least $300 for the year, I think you should think about that very, very strongly and get that tax deduction that also benefits the charity of your choice.
Yeah, stay there for one more second, Mike, sorry. You'll find we do this with each other
on this. Yeah.
a lot, I know. Well, one of the things too, I was going to say, if you're kind of in this middle bracket where maybe you're going to do more than the $300, but if you're touching and getting close to that standard deduction limitation with maybe some of your other itemized, you know, your mortgage interest, if you have that, and your real estate taxes and things, just a tax tip is to think about a little bit of planning opportunity and maybe bunching some of your donations to try to, if you're close to getting above your standard deduction for 1 year, you may want to go ahead and grab some of those charitable contributions and take those in that year so that you get the better benefit of them. So it's a little tax tip if you're kind of riding on that edge of the 12,400 of deductions for single people. So just didn't want to miss out on that. Okay, so let's talk for just a minute about contributions you can deduct. So we've mentioned qualified organizations, and that is your public charities. That organizations have to meet certain rules in order to be qualified as public charities. They file tax returns with the IRS that helps meet those, that shows them the math and proves that they're a public charity. And so you have to, when you give money to, it has to be a qualified organization. That means that it can't be a specific person. You also can't give money to an organization and say, hey, I just want this, can you just set this aside and only have, you know, this is for Laura's, you know, commuting expense I want to cover next month or something. That's not that it has to be for general use of the qualified organization. One way you can check on organizations if you have any questions is you can go to the State Attorney General website, and there is a charity check on that website, and you can go there and make sure that they're in good standing, and also check to see their status and make sure that they can that you can get a deduction for donating to them. In a few slides, when I turn it over to Mike, we are going to also talk about the acknowledgement letters they'll get back to you, and the paperwork that you have to keep for this.
Joan, can I ask a quick question? We have a question from one of the participants. It says, what about GoFundMe and those kinds of crowdfunding tools? Can I deduct those donations?
No, technically you cannot, because GoFundMe is not a qualified charity, and we know that there are a lot of good causes on GoFundMe, and a lot, you know, and they're very popular out there, but technically you cannot deduct donations to GoFundMe and those crowdsourcing websites. Every now and again, I would say there are some that are pass through. Well, if you find one that's a pass through, I've seen this before too, where they're just collecting money and passing it through to a 501c3, and the 501c3 gives you an acknowledgement letter, but the GoFundMe is not one of those that does that. Yeah.
Thank you.
Good question. We see that all the time too. People give us their GoFundMe stuff, but unfortunately it's not deductible.
Yeah,
Okay.
The other thing I would add, it's a little bit small on the slide here, but you can look on publication 526 if you just Google that, or DuckDuckGo it, take your pick of search engine. But you'll see on the not deductible all the things that we usually see as questions from clients, and I think we should add in the GoFundMe one because we do get that a fair bit. But the other one that's on here that we do get a fair bit of questions on is the value of time or services that you provide to an organization as a volunteer. That is not allowed as a deduction, but the out-of-pocket expenses that you incur are allowed. And so it's a little bit of a nuance of the one or the other. And with the acknowledgement letter stuff that we'll talk about in a little bit, it usually doesn't become an issue because people don't think about it, but it is something that you should. If you are volunteering for an organization, you can get a deduction for the out-of-pocket expenses that you have. Joan, anything else on this slide from you?
No, we'll go on, and we'll go on. Thank you. So here's another tax idea that we'd like to share with you. if you have appreciated stock long-term that you've held for more than a year, there is actually an advantage to donating stock instead of cash. The advantage is that you get a charitable deduction equal to the fair market value of the stock that you donate. So, and then you also don't have to pay capital gains as if you sold the stock and donated the money and the cash. And so it's really like a double benefit. It causes you not to have to pay tax on all of that appreciation, plus it gets you a deduction up to fair market value. Sometimes people haven't really thought about this. It also helps save the cash in your bank account for liquidity purposes. You can still go out and buy the same stock again and refresh your portfolio if you want to. But this is another option. We did not include in this presentation other types of items that you could donate, but assuming that the charity takes other types of property, there are lots of complicated assets that you could donate, such as partnership interests, digital assets. I always have to throw that one out. But as you're thinking about wanting to help an organization, I would just encourage you to think beyond only cash. Now, if you do stock, just one thing, that does not count for the 100% limitation in 2020 because it's not cash, it's stock. So that would take you back down to 50% when you give to a public charity. So again, just thinking broadly, if you have something and you really want to support an organization, talk to the organization first. If it's something other than cash, make sure they have an acceptance policy for it, and as many do, and then you can make arrangements to do this instead and save your cash.
And RMHC Bay Area does have a stock acceptance policy. We do accept.
Perfect.
Which is very helpful.
So we're going to spend just another minute on contributions you cannot deduct. So again, we've already talked about a couple of these. You know, it cannot be to a specific individual. It cannot be to a non-qualified organization. What we mean by that is sometimes you have membership organizations that you like to belong to. If it's membership dues, those are not charitable deductions, they're membership dues. Political organizations, you can't deduct anything to a political organization. If you make a deduction and you receive something back as a benefit, a good example of this is if you're going to a charity event and you pay $100 for the ticket, and you receive a meal back because it's an event and the meal is worth $25, then your charitable deduction is only the difference, the $75. Mike mentioned the value of your time or services. That is not deductible. We know it's priceless, but it's not a tax deduction. Your personal expenses, the one exception to this is if you incur expenses on behalf of the organization and and the organization gives you an acknowledgement letter acknowledging that and that you've incurred them in lieu of reimbursing you, they can treat that as a donation as well. Then that's one. But anything that's personal is not deductible. Appraisal fees, if you're giving away those unusual assets that we mentioned and you have to get something appraised, that's not deductible. Certain contributions of donor advised funds and partial interest in property, which that's just getting in the world of complex. So any questions at this point on contributions that are deductible and thinking beyond cash, not deductible, certain items, and the benefit of doing those deductions, particularly in 2020. And then go ahead, Mike.
I was just going to add, the one thing I would add here, because I know we have a diverse group on this webcast, so I know this isn't going to apply to everyone. But if you're of the means that you have a more sophisticated giving strategy and you are, and to Joan's point, you have a more diverse portfolio of assets that you may want to donate, it is very, very important to have the right advisor helping you on that. And it doesn't have to be Joan and me, that's fine. But your own tax advisor needs to be working with you as the structuring of those donations. We've seen a lot of times where clients come to Deloitte to have help on trying to figure out things like this, because these rules and we'll get a little bit into this a little bit later, but the rules are very complex if it's not cash to a public charity. And those rules are really onerous on the donor to make sure that the deduction is really a valid deduction. And so we've had, we won't give you too many war stories here, but we've had where, people have given cars. I've seen a plane being given before, which is, an interesting concept. But without the right documentation on both the donor and the donee side, the deduction itself is at risk. And these are very easily auditable by the IRS. And so you want to make sure that you're crossing all the T's and dotting all the I's very, very reasonably.
Great. Well, perfect segue into the next segment where we're going to talk about the rules to make sure now that you've done this, making sure that you actually get the deduction and it stands up under any type of questioning on your tax return.
Perfect. Thanks, Joan. Timing does matter. We see a lot of clients come and ask about making donations at the end of the year because for two reasons. One, charities like to have giving pledges at the end of the year because they know that people are looking at the accounting period of the year and the tax implications of the current year's income. And so there is a benefit to doing things in the current year versus the next year because of just the timing of the donation and the timing of the tax payments related to that year. So just as a refresher for everyone, generally the IRS has a rule that says as long as a check is mailed to the charity by December 31st and cashed within a reasonable time, then the deduction will be valid for the December 31st date. Credit cards, same thing, as long as the payment of the charge or the charge goes through before December 31st, the payment in the next year doesn't matter. It will be a December 31st. Securities, it will have to be transferred out before December 31st. Real estate, we do see gifts of real estate, believe it or not. That will control under state law, but basically it's when the deed is recorded with the county. Ultimately, this is a state law question. If we really got into the nuances of it, we'd probably bore you all to death, so we won't get into it too much. But just in regards to overall planning, be aware that you can do things on December 31st that are valid, even though the payment may not happen until January. I will say, though, that the best practice is don't do things on December 31st, please. Do them on December 26th or 27th, so that way you have time to get everything squared away and it gets processed in time, especially if the number's big. We've had some clients that do big numbers, and I'll let you define big number in your head, but when big numbers are involved, it's a real miss if for whatever reason there was a foot fault and that donation is not happening in the current year, but it's going to end up happening it'll happen in the next year. So Joan, I think that's all I had on this slide. Anything else you would add on this one?
No, I'd say that the story we hear the most, at least when people were writing checks, is they on January 3rd open up their desk drawer and go, oh no, there was that check that I wrote, and intending to get it off by the end of the year. So I do really like that advice of backing it up a few days just to make sure that everything goes through.
Yeah, and I would all. Oh, go ahead.
There's a question from some of the participants. It says, I've heard Mike and Joan use the term qualified public charity. Is there such a thing as a private charity? And if so, what is the distinction?
Oh, that's a good question, actually. Joan, do you want to tee that up with your foundation?
Sure, I can tee it up, and you can, and then you can add too.
Yeah, sure.
Yeah, that's great. There is a qualified public charity is an organization that gets more than 1/3 of its support from what we consider the general public. And those are examples of the Ronald McDonald House here, and then also like Red Cross or Goodwill or somebody like that. So they get a broad base of support. There is another type of an organization that is also a charitable organization, and it's called a private foundation. And the biggest difference there is a private foundation can be funded by fewer sources. And oftentimes they're funded primarily by a corporation or a family. It doesn't mean that you can't give to a private foundation. You certainly can. but it does mean that, generally speaking, that type of organization has a more narrow base of support. For your individual income tax purposes, the amount that you can deduct based on your income varies slightly between a public charity and a private foundation.
Yep, I agree with that. That's the main thing that we see is public charities generally are the ones that have very broad, giving pledges, trying to get donations from donors, whereas private foundations are, one family group is funding that foundation. The qualified part of this also applies to the IRS's application process to be a public charity. So you actually have to put, if you were to make your own public charity, you would have to find funding for it and get outside support. But you also have to apply to the IRS to be recognized as a public charity. And that's a process in and of itself. But we do see clients do this. I mean, we do see people have a passion around cause X, whatever that is, and they have enough people that they can go around and gather money from and become a public charity in and of themselves. So, but there are very, very, just as an aside, there are very onerous rules around running a public charity, which I'm sure Bree and Laura are very well aware of, about, you can't enrich yourself, you can't use the money for your other things. I mean, there's a very big regime regulatory to make sure that this money is being used for charitable purposes. Perfect. All right, so now we get to the one thing that we want to, not scare everyone too much, but give you a little bit of flavor of what as tax professionals we worry about, what keeps us up at night. And we gave you a little bit of this a little bit earlier about record keeping and the complexity of this area when it's not cash to a public charity. I would say, and with Bree and the team and Laura earlier before we had this presentation, I made sure that I wasn't going to get myself in trouble by telling you about all this, because I did confirm that Ronald McDonald House is doing this properly for you guys. So when you make a contribution to a charitable organization, you have to be able to substantiate that contribution. And we're going to talk about this a little bit more broadly in a couple slides. But overall, just to give you guys a sense of what we deal with as tax professionals, the IRS is very easily auditable on this topic. They are very easy. It's very easy for them to send you a letter as a donor and say, hey, I see that you took a donation of $500 to this charity. Please, can you send me the letter that the charity sent you to substantiate that document? Do we see this a lot? Not as much as you might think, but we do see it. And it's a very easy ask of the IRS to send you a letter. And what you do is, you have your letter back from the charity and you send it to the IRS and it goes away as an issue. But what we also see sometimes is that people don't have the letter. And without the letter, the IRS is able to disallow the deduction. So it's very important as you're making donations that you're following up if the charity doesn't give you a record to substantiate your donation in a reasonable amount of time, to follow up and make sure you get that letter, because you need that letter in your tax files to make sure you get the donation deduction, I should say. Let me go to the next slide here. So what does that look like? So if you're giving a monetary gift, so cash gift of less than $250, you need a written record, which is the credit card statement, the canceled check, or the written communication, which would include email too, from the charity saying the donation. And it has to show the name of the charity receiving the donation, the date of the contribution, and the amount of cash that was paid. This is pretty simple. Less than $250 is sort of level one of complexity of anything and everything. So this actually is not too much of a problem, because you can see a check from your bank statement if it's there. You can see the written email back. If you're sending it through the website, not a big deal. Where we get into more complexity is if it's more than $250. And this is where we needed a formal written acknowledgement letter. This is a term of art in the tax world. And so if you have a tax preparer that works with you, this should not be news to them. But what this means is that this letter is required. A canceled check is not enough. If the charity writes you back and doesn't talk about all these different things, which we're going to talk about in a second, it's not enough. So I don't want to disincentivize you from giving more than $250 because, to be honest, this is very, very standard now in the industry. These rules and regulations that the IRS has around this item has been around since, I want to say 1992-ish, something like that. So it's been a long time. And they've been updated in the last couple of years also. They keep on adding complexity to them. I will say, though, not every charity does this properly. The one story that I'll tell you is we had a charity that sent a letter, and it sent a letter that I knew it was wrong because I was reading it, and it said that it was following the regulations that were promulgated under, I think it was called the War Powers Act of 1934 or something like that. And you know, if I told you that the rules and regulations were in the 1990s and someone's quoting the 1934 law, it's not up to date. So what you're looking for is, and this is what we have our team look for, is the written acknowledgement has the name of the charity, the date of the contribution, the amount of cash paid. Those are all easy. Everyone gets those. Where the misstep happens is a statement as to whether goods or services were provided to the charity in return for the contribution. And this is what Joan was talking about before, about if you bought a ticket for a charitable event and they had a dinner, they would say on their acknowledgement letter, "Thank you for your $100. In exchange for your contribution, you received a dinner of $25. And so that is what you're looking for, is that goods or services language. And it's not fatal if you get something back. It's just that you can't deduct the full amount. So for religious organizations, they also talk about intangible religious benefits. That's just one more thing to do. So the only other part of this where we've had traps before is if the IRS comes in and asks you for the letter and you don't have the letter because it didn't get sent to you, unfortunately, it's very clear that you are not able to go back after you filed your return and receive the letter. So it's one of those things that you need to be very careful of as you're making these donations, that the charity is giving it to you. And I know that the Ronald McDonald House has a very specific process to make sure these go out on a timely basis, so that way no one runs into this rule. But it is one that we do see. Other charities sort of have a foot fault every now and again where they don't necessarily send the letter in time. And that's not a good answer, as you can imagine. Joan, anything else you would add on that?
Just a couple of things. Sometimes a charity decides to send one letter out at the end of the year, and that's fine too, and it'll have a summary of all the donations, so it doesn't have to be one letter for each donation. But if you but to Mike's point, one of the best practices is collecting these as you go through the year and just putting them in a folder and somewhere on your computer and just having them all together, so at the end of the year you don't have to go back and scramble and try to go back and to the charities. And if you do have, and that will also give you enough time to really check for this language. If it's not on there, please go back to the organization and ask them for a new letter, because as Mike mentioned, we see a lot of letters and a lot of letters that are not as correct as they should be. And I think the community, the not-for-profit community, is getting better about it, but we're not perfect yet.
I'll just say, yeah, we're on year 30 of this regulation that requires this goods and services language, and we still don't have 100% of charities doing it properly, unfortunately. But
yeah, that's right.
They are used to being told that they need to update. So don't hesitate for a minute to ask them to update. So.
Absolutely. And then the one last thing that you had on there, which I thought was a good one too. This one's come up a lot. If you do have your own family foundation, you need to give yourself a letter. So yeah, make sure you're giving that letter.
First world problems, but we do have a diverse group here on the call. But yeah, that's a very good point. So it doesn't take much to keep Joan and me excited, and we're a little bit of tax nerds, and so this is the one rule that we always we advise both wealthy families and more modest families. But on wealthy families, as Joan was talking about, those private foundations, we make sure every year that they're giving themselves a letter, which is sort of I won't use the right adjective, but yeah, weird is the good one to use. That's it that we had on the presentation itself. Was there any other Q&A, Bree, that you see?
None have popped up, but now would be a good time if there's any lingering questions from participants. By all means, ask.
Yeah, this is one of those areas on the more you pull back the onion, it gets more and more complex. So happy to have a question or two if there is any.
Oh, one came up.
Perfect.
Someone asked if we'll be able to get a copy of this presentation. And the answer to that is yes. We will send out a link. It's been recorded, and we will send out a link probably early next week to all of the participants that attended, but also those that were invited, where you can review the information shared today. Thank you for asking that. I failed to mention that. And before we wrap, I just wanted to give a little bit of information about a campaign that we are actually launching. Well, the board, our board, RMHC Bay Area Board, is launching in the coming days, next week. Our Give for Kids Challenge. Our board has been incredibly generous in helping our organization meet our $1.4 million projected shortfall this year because of COVID. We've had to cancel our events, and that has posed a real challenge for fundraising for our organization. And so the board has come forward. We've had 100% participation in individual giving from our board and through their networks, with our board alumni group as well, have raised $500,000, and they've issued a challenge to the community to match that, to raise $1 million to help fund our operating budget for this year. You know, we're seeing a lot of spikes with COVID right now, and with our immunosuppressed population of families that we house and the meals that we're serving to support our other partner hospitals in the Bay Area, we're hunkering down and being incredibly conservative to make sure that our families are safe and being cared for. So I encourage you all to check out our dedicated page for this campaign, and we will have a video next week that explains a little bit about what we're trying to achieve. But every little bit helps, and of course, thanks to Joan and Mike, you have some more information about how to make your charitable contributions work in your favor this year and beyond, if you're able. So thank you all for joining us today. And again, you can look for the recording next week. And if you have any other questions, you can respond to the invite and also ping us through our website. Thank you very much.